Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard. John, what's coming up on the show today?
Jim, today we're going to talk about the disconnect between the gold price and gold juniors and introduce a brand new favorite that can take advantage of this disconnect.
Why do you think there's such a big disconnect between the price of gold and gold juniors?
Well, one of the problems for gold juniors is that people are disconnected from them in general. And it's not just the gold price that's the problem. There are three types of gold juniors. The first kind is the one that I like best, which is the discovery exploration play, of which there's been some great examples in the past, such as Hemlo in 1982, SK Creek in 1989, and Fruta del Norte in 2006. Now, the historical audience for discovery-oriented gold juniors has been Canadian speculators and, to some degree, Americans. The second type is more of an innovation type story where it's new process technology that enables gold to be recovered much more cheaply than has historically been the case. And there haven't been that many recent examples, but the most famous was during the 1980s when heap leaching came along, and suddenly these low-grade oxide gold deposits in Nevada could be open-pit mined and heap leached, and you didn't need an expensive milling complex. So that was an example of new technology coming on and suddenly dragging deposits that were known to exist into the money. Now, the third type of gold junior is the optionality play. Now, historically, discovery exploration finds a deposit and then they do the numbers on it and discover, the grade or size just isn't enough to make it worth anything at the prevailing gold price. And this type of play did not exist until the end of the 70s, because when gold was fixed at $35 an ounce, we had over time a case where existing deposits became worth less and less and less over time while costs rose. Now, for gold deposits, as with any metal deposits, the primary input is energy in some form or other. So gold, when you extract it and process it and concentrate it into physical gold, it ends up being stored energy. Now, in 1972, when Nixon released gold from its $35 prison, gold started to do catch up for many decades of inflation. And so the 70s were this bizarre period where it charged as high as $850 by 1980, and then stabilized at $400. Now, this was a tenfold increase, and only about 20% of that was you could actually measure it from historical inflation. This was a real price increase. Now, what this did was it created this idea that gold could do this again. And that's where the whole sort of hard assets concept came in, and the Doug Casey's of the world became the talking heads, predicting $2,000 was coming, tomorrow. In fact, didn't come over the next 2 decades. In fact, by the end of the millennium, gold had sunk down to the 250 to 260 range. But before I get into that part, the discovery exploration play, currently my favorite is Solitario Resources Corp, and with its Golden Crest project in South Dakota. Now, during the 1980s and 90s, everything amongst the Canadian juniors was generally about the discovery exploration, at least as far as the Canadian investors were concerned. But what really worked at the time was that the financial sector, through the brokers, they acted as information hubs, network hubs. There was no internet. Information was hard to come by. The brokers functioned as intermediaries between the promoters and whatever news sources such as the George Cross newsletter was available, and their clients, who every time they traded got charged a 3% commission. So that was the business model. The brokers had an interest in keeping everybody excited, everything going. But in the late 90s, it switched to a deregulated commission. It was no longer 3%. Discount brokers came along. The financial sector gradually shifted towards asset gathering, where they aren't interested in making people trade. They want to gather the assets into their account of high net worth individuals and then just make their money, charging some sort of a fee for the year and making sure this portfolio's value doesn't go down by any significant amount, and ideally track all the index returns. So the broker no longer plays this role. But it's even worse now that the financial establishment has its trading departments, and they know that the investors still exist out there. They still buy these juniors. They see a good press release. They buy into it. And these trading departments just sit there waiting for incoming buying, and they can just sell with impunity into the incoming buying. And then when that starts to dry up, they can just lean onto the bid side and continue to sell short, knowing that when they snuff out the momentum, there will always be a cascade of selling that allow them to flatten out their naked short position and never actually have to borrow money. So the financial establishment isn't just useless to the resource junior sector, it is now harmless. And so the investors have basically been stuck going to the social media circles, but these are all disconnected. They're all islands unto themselves. So this unity of lots of people following a particular play, like used to happen in the 80s and 90s, that has pretty much disappeared. And now we also have a new problem, and we saw this with Aurelian. Now, Aurelian was a fantastic discovery in Ecuador, a major gold mine that is now in production. And the stock went from 60 cents to $40. The market is now sophisticated enough that when they do see this big discovery hole, they price it to maximum value very, very quickly. So if you're not on board before the discovery hole, it's really too late to get on board and make some money along the way. The idea of a play growing and growing, as say the Corona did in the Hemlo days, or SK Creek did with Calpine and Stikine back in the early 90s, that really doesn't exist anymore. And this is why you have this problem where anybody who buys a junior has to buy it before the results are out, but you're now dealing with a lottery ticket. There is no anticipation cycle anymore, and if anything does try to happen, the vampire squids in the Canadian financial establishment, well, they harvest whatever comes in. So these juniors are basically stuck as lottery ticket beds when they are discovery exploration plays, and I think by the end, unless something dramatic changes, by the end of this decade, this ecosystem is extinct. Now, what I do like about Solitario and its Golden Crest project is that it has several deposit models as targets, but it also has several scales of potential outcome, from some 4 to 5 million ounce deposit, 2 grams per ton open pitable, similar to what Rupert found with its Ikkari discovery in Finland. Then there's a bigger scale where there's a lot more ounces, but then there's even the district scale, that this could be another homestake district, a mirror image of the other side, the northeastern side of the Black Hills, where 90 million plus ounces have been identified, 3/4 of them already mined. So this possibility exists here with Solitario Resources Corp, and they are now drilling, and we will see if they start to deliver. The market, true to form, it's afraid to really dip its toe into it. It wants to see that the third dimension looks similar to the surface, the 2 dimensions that surface. So we need to clear that milestone first, but I want to point out that Solitario doesn't just trade on the TSX. In fact, it also trades on the NYSE AM exchange under the symbol XPL. And that's where Robin Hooders and everybody can trade. An entire generation of youngsters who don't have the capital to have these big accounts that the asset gatherers are into. So Solitario could become the discovery play superstar later this year and keep growing and growing, because all these different scales will not be found right away, thanks to permitting, which some of these permits will probably take another year to be able to test some of these additional targets. But this is the type of story that can keep growing and growing bigger and become a poster child for introducing younger audiences to resource junior discovery play exploration. Now, the disconnect comes into play for the advanced gold projects. And while there was a lot of talk during the 80s and 90s about gold going to $2,000, it wasn't that big a deal, but it became a much bigger deal in the 2000s when the gold price started to go up. Now, today, gold is around $2,400. If you inflation adjust gold from $400 in 1980 with the CPI, you end up with a price of like $1,554, something like that. And that's a real price gain. With the difference between that and 2,400 is a 54% real price gain. Now, the story that attracted the American investors during the 80s and 90s, after they witnessed what happened in the 70s with gold, these were generally Republican-type investors, individually wealthy, and they loved hearing the story about they were people of merit, self-made people, never mind that some of them inherited their wealth, and they loved this idea of free market capitalism, of laissez-faire markets, free trade, all this kind of stuff. It was very libertarian type of thinking, and they were like genuinely interested in seeing democracies kept free from the predation of tyrannies. And what they were worried about was that their well-earned wealth would be taken away from them and redistributed to the people who were needy, because obviously they lacked merit. They were losers. So they loved hearing the story about how the big government was a bad thing, and eventually the debt will grow and grow. The fiat currency system, everything will eventually collapse. And so how do you protect your wealth against that? And that's where gold became this new idea, because once gold was no longer a gold standard fixed at a certain price, it could go anywhere, and it would ultimately reflect the value of the energy cost to get the next ounce out of the ground. So whatever inflation came into the system, it didn't matter what the money numbers were. The energy inputs would be rising. So it meant that the real price of gold, as well as the inflation-adjusted price of gold, would keep going up. So people bought gold, but gold had a problem. See, gold is a collectible, and if you sell it, you get charged, and have held it at least a year, which presumably you have if you've done it as a long-term investment, you lose 28% to the government, and more if the state you reside in also applies a tax to that. And of course, the standard gold bug story was that, CPI understates the real inflation, so that this 54% real gain that I'm talking about is there. It doesn't really exist. It's actually much worse. So owning gold at 400 and selling it here at 2,400, man, you're a super chump, because you're losing a good chunk of the gain and ending up with less buying power than you started with. And so most people understood that this was kind of a dumb concept, and while they could like to get worked up about the idea of an apocalyptic societal collapse where there are no more tax collectors or anything, they also really didn't like the idea of, okay, so now we have anarchy and chaos and crazy people, lunatics with guns coming and looking for those who have gold. So they didn't really like that particular story. And that's where the optionality gold play came in, because you take a deposit, okay, it was exciting when it was first discovered, but then it wasn't quite good enough to be developed. But if the real price of gold does go up, and the nice thing about gold is it doesn't have a formal inflation tracking linearity. It goes in leaps and bounds. In fact, it sat and did nothing for 20 years in the 1980s and 1990s. And then after the financial crisis in 2008, it shot all the way up to 1900 before retreating back to the $1,100 range. So it's the capacity of gold to make significant real price gains, which makes these marginal deposits that are break even at the prevailing price very interesting. And they end up having a low market valuation. So the whole gold bug thing was to buy these advanced gold juniors and just sit on them, because if gold suddenly makes a substantial real price move, all of a sudden for these things to be worth developing, the net present value has to at least match the capex, and the capex is usually large for these deposits. So that means when you go being priced as an optionality thing, which is like 10% of the capex, you're talking like tenfold gains if the price gets high enough to start clearing the development hurdles. So this is what the traditional American gold bug investor really loved, the possibility of having to pay taxes on 1,000, 2,000% gains as a result of owning these juniors, and gold taking off, and not necessarily because the world is coming to an end, but because it's adjusting to new realities. But this is not happening today. Like West Fault Mining is one of my favorites. Based on they've got a shovel-ready project, the Hasbrook, 72,000 ounces production for 8 years, and it should be priced in the 2 to 250 range if the American gold bug investor was still in the market. But it's languishing at 90 cents to $1, which is very, very cheap. Now, one could argue maybe it doesn't have the scale to be of interest to a major right now. But if you believe gold's going to $3,000-$4,000, then the cash flow that would come from this operation is big enough that it would get developed and it would be bought out at 5 to 10 times current price. So there's a disconnect. People are not buying these things in anticipation of a higher real gold price. Now, you ask yourself, okay, what has happened? Why is there this disconnect between the current gold price that we have, 2,400, and projects that kind of make the hurdle at, say, base case prices below 2,000, but are way into the money at the current time? Why do people not buying these things? Now, one could be that they do not believe gold will stay here. They think gold's going to crash back below $2,000, where these projects become sort of iffy. And of course, if gold's gone back below $2,000, maybe it'll go back to $1,300 or type of thing. So there's this reluctance out there. But there is something else that has changed. The Republican Party has been taken over and remade by Donald Trump. Today's Republican is not the Republican of yesterday. Today's Republican is all for industrial policy, all for protectionism, is perfectly happy to throw a democracy like Ukraine to a tyranny like Putin's Russia. It doesn't care about this stuff. It no longer talks about freedom or anything. It talks about taking away the freedom of women and people and making them conform to some dogma type of system, sort of a Christian version of Iran's theocracy. This is not what the Republicans used to be like. And they have this big MAGA story about making America great again, which is kind of a slander because America is still the greatest nation out there. But the reason that gold is going up is because the trend is for the global West to be eclipsed by the global East, and the United States, with the policies that the Republican Party has chosen, will accelerate that by isolating itself from the global West, which means that it'll be America against everybody. And all these other nations are now hedging against a future where America becomes a diminished actor on the global stage. No longer has this indirect influence over everything. It's just this isolated entity lashing out at everybody, not helping the allies or anything. And that, of course, means the U.S. dollar will cease to be the global reserve currency. So your typical American investor in gold, even though they were trashing where America was going, were actually very, very happy with what America was all about, what it represented. But the structure now is that the price of gold going up is symbolizing the demise of America. And so they've become almost like they've traded places with the Democrat Party, except the Democrats, they were never interested in gold. They were interested in technologies that change prosperity. So, and of course, with gold being something everybody else wants, Bitcoin's the alternative. Bitcoin is a digital mirage that is priced in US dollars. And it's premised on the idea that there is an infinitely large box of greater American fools to whom these Bitcoin could eventually be sold, and with the cash then used to buy real assets. So that's what Bitcoin is. But that doesn't require you to have any sort of concerns about why Bitcoin is going up. Bitcoin just goes up because it goes up, because it can. Whereas gold is going up for reasons that do not sit well for the future of America. And this disconnect, the disappearance of the traditional audience for these Canadian advanced resource juniors such as Westfault, this is what's creating huge value opportunities that are staring us in the face.
What is your new favorite junior for taking advantage of this gold disconnect?
The company that I had as a bottom fish for several years is Vista Gold Corp. And last week, I made it a Good Spec Value Favorite after I took their updated feasibility study from March, ran it through my discounted cash flow model sensitivity calculations, and stress tested, found out why is this thing sitting here so cheap? Is there a special reason for it? And came to the conclusion it is the legacy history of the project, and it is the evaporation of a contemporary North American gold bug audience, which has resulted in this stock sitting in the 50 to 55 cents US. Now, there's only 126 million shares fully diluted, so the valuation is like $65 million. But at the base case price of $1,800, at 5%, the project was worth almost $1.2 billion. And if you use 10%, which nobody uses for gold projects, it was $564 million. Now, the capex for this project is just over $1 billion. And we're talking U.S. numbers here. So at 1,800 gold, the NPV just hits that capex hurdle where the NPV should be at least equal, if not more than capex. And the IRR, which is supposed to be 15% or better, it came in at 20%. So at $1,800 gold, you could sort of sit there, yeah, this conceivably could be put into production. This was for a 50,000 ton per day open pit milling situation. And it was based on 280 million tons of 0.77 gram per ton gold. But when you run the numbers at $2,400, at 5%, the NPV is almost $3 billion. And at 10%, it's $1.8 billion. And if you really want to be like a traditional gold bug and say that, gold's going to reprice upwards in real terms to $4,000, we're talking about $4.7 billion to $7.2 billion. Now, what does that mean? Most people can't do mental math. So if you divide those numbers by the numbers of fully diluted, at that $4,000 price, this thing would be worth $37 to $56. At the current price, it would be worth $14.5 to $23. And even at the base case price of $1,800, it would be worth $4.5 to $9. And yet it's trading at 53 cents. Now, it isn't just the lack of American gold bug investors that are out there that are keeping the stock so cheap. This project does have history. It has twice been the cause of major failures in the 90s. It was discovered in the late 80s. It was first developed as a heap leach mine. They did about 13 million tons, and they had terrible recovery problems. There's still a half gram or so left in the heap leach, which they are going to eventually blend in with the ore from what's still in the ground, and recover that with the milling system that they developed. And then Pegasus took over the project. And Pegasus was this great American company. It was also very much into heap leaching, all about it. Bought Mount Todd, acquired Mount Todd, and it spent $230 million US at that time to build a milling complex. But they had not really done the metallurgy. And the metallurgy killed them because one of the problems they had was that there turned out to be a low copper grade in the deposit, which consumed cyanide way more than expected. So their recoveries were terrible, and they got this going in about 97 or so, just in time for the gold price to start its trip down to 250 to 260. And by early 1998, they were forced to stop production, and then the bankers pulled the plug on them. They ended up in bankruptcy, and that's where that project sat until 2006. Now, we got to do some Vista Gold history here. Vista Gold was part of the Rick Rule universe during the 90s, and during that period, so when the bear market began, it acquired all these other projects that were marginal, and it was kind of a synonym for this idea of buying marginal, near worthless deposits while betting on a higher real gold price that drags them into the money. And had all these people like Brian London and Doug Casey talking at all these hard assets conference, talking this story. And they reorganized the company with a 20-for-1 rollback and continued along this path. And they spun out an awful lot of these deposits that they had acquired. But Mount Todd, they kept, and they only paid a couple $1 million in stock and cash, and the cash went to the trustees, the bankruptcy trustee, and the stock went to the Jawang Aboriginal people in whose jurisdiction this sat. But it did come with a price, and it's now cost them $3 million a year in site maintenance. So the $115 million they sank into it, only a couple of $1 million was acquisition cost, but a good chunk of that was just maintaining the site. But what they have done is multiple pre-feasibility and feasibility studies, always working with this project. And I've published a tracker which goes through this entire history. I don't want to bore people talking about it. They can read about it. I've got some great graphics which show where this happened, both in terms of the gold price and in terms of the stock chart. And always it was just on the border of being in the money. So the last decade, this stock has been an absolute dog. They've kept their fully diluted pretty cheap because they do have this NYSE AM listing in addition to the TSX listing, and they trade most of their volume on the NYSE. So again, this is a stock like Solitario, which young people, Robin Hooders, can trade. So when a younger generation gets their head around a story like this and sees that, oh, you can buy $10,000 shares of this at 53 cents, and this thing has the potential to go up 10 times, maybe 20 times if the gold price starts to soar. This would be an excellent way for them to discover how this, not just the gold sector, but the metals sector works. Because you need to understand the discounted cash flow model, all these concepts, how to run these numbers to truly appreciate why this project is going to be developed and why it is undervalued. Now, the company put a lot of effort into the metallurgy, and part of the knock against it right now is, well, it killed 2 operations. The metallurgy is hopeless, but they've put a lot of effort into it. They even discovered that by drilling deeper, that the copper's confined to the upper third of the deposit. Below that, there is no copper that's stealing the cyanide. So when you look at their mining plan, it's weird. Some years they're mining a lot more than they're processing in their mill. Other years mining a lot less. What they're doing is they're stockpiling the copper ore, and they've developed an ore schedule to blend the copper contaminated ore with the clean ore to a level where the copper's cyanide consumption is manageable. It's not the big deal killer. So they believe they have solved all the metallurgical issues. They got almost 92% recovery. They updated the feasibility study in March, so the numbers that we have are after this sort of 20% inflation that the market, that the global economy underwent. And this project's sitting there, shovel-ready. All the permits are in place. The Zhawang people have converted their 10% participating interest, which they were never going to be able to raise from anybody, into an NSR. So they're going to make money on this, regardless if it ends up being profitable, and it'll also track the price of gold. So here's an ideal project in Northern Territory of Australia that this company rescued from oblivion, spent 18 years doing feasibility studies in and detailed drilling it, understanding the ore controls. This thing is shovel ready. A couple of years ago, they hired CIBC to see if they could find a partner, because a couple of years ago the gold price was bumbling around $1,800 to $2,000, and they had all kinds of potential farm-in partners who would have ended up with 70, 80, who knows what percent, and that would have made Vista Gold into a dead money play, minority partner, waiting to see if the big developer succeeds or fails at developing this thing. Now, with the gold price where it is, they're not so keen about doing something like that. This is now a stock that's entering a competitive auction, and the big companies, the market's still not taking this gold price seriously. But when the real market, when the general market starts taking $2,400 gold seriously and expecting higher prices, real prices, in fact, then you're going to see an inflection point. And when the big gold producers' prices start going up, then they will become braver, and they will also be in a position to offer paper to take out Vista Gold. So Vista Gold, a classic good spec value favorite that's extremely leveraged to the price of gold, and it's liquid enough for even sort of high net worth investors to get a decent position, but it's definitely something that everybody in the Gen Z or millennial should take a look at and use as their starter position to start to understand how mining and metals work. And they should also buy Solitario, which is at the other end of the spectrum in terms of an exploration discovery play, which has its entirely different dynamics. But both of these have potential to deliver 10 to 20 baggers for different reasons over the next few years.
John, thank you so much for the update.
You're welcome, Jim.
We've been talking with John Kaiser. I'm Jim Goddard. Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.